Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The low water mark of the 18th of August was pivotal to the construction what happened next. Back then, the market failed to break down through the neckline, currently at 825, and highlighted in red on my daily chart, of the small but influential October 2021 to January 2022 head and shoulders top. Now please bear this neckline in mind, as it will crop up again later on. Anyway, the market chose then to construct a new pattern, a bull channel. There was a small free zone above at the time during September, all the way up to the July 2012 high at 957. However, when the market reached the 957 area, I thought there might be issues. You see, 957 is the gateway to a congestion area above between 957 to 1001, within which prices rose, pushing up over the now flatlining long moving average, currently 1007. Additionally, a lot of this congestion was old and had been made up from 2011 and 2012 and was easily breached on the way up in February and on the way down in June. However, back in those days, the congestion did not have the additional reinforcement of the long-moving average in its midst, and it is this reinforcement, along with the upper bull channel line, that constrained the market in early October. In the process, the market took on a new shape, primarily caused by the weekly key reversal down, made that same week. In fact, it's hard to judge if the shape made the weekly key reversal down or vice versa. Anyway, at the end of that week in October, the market broke down through the lower bull channel line and also dropped out of the overhead resistance area and even started moving below the now flatlining medium moving average for a while. And that's currently at 914. Then along came the very early November action, or as I refer to it, a week of time wasting, but also a week of defining industry. This is a parallel of what we saw in Chicago wheat futures. I will expand on that shortly, but first, much like Chicago wheat, though it's not a complete duplicate, this market here had two avenues. In this case, as in Chicago wheat, the market chose the first avenue. To describe this route, I'll refer to my commentary from a few weeks ago, and I quote, "The first is the straightforward move down with potential targets for the break of the bull channel. Thus, we have a primary target X down in the 903 zone, whilst the secondary harder to reach target X1 is way down below in the 759 zone." End of quote. 2 weeks ago, the bearish pressuring of the market finally started to show results, with a significant dip below the medium moving average and reaching the primary target at 903. Last week, this continued low all the way down through the 50% Fibonacci line of the August 2020 to May 2021 move at 900. And the 50% Fibonacci line of September 2019 to May 2022 move at 881, as well as the 2013 high at 862. This week, early on, much the same happened, down through the 2014 high at 855, but then on Tuesday the market hit the red trend line on my daily chart, the neckline of the small but influential October 2021 to January 2022 head and shoulders top, and the one I earlier here asked you to bear in mind, and things stopped. At least for now. As I stated last week about this neckline, I quote, "It will all depend, should prices choose to move lower, what they will do at the red neckline. Remember, the market was held up by this simple looking support back in August. This is where we can," end of quote, this is where we are now. I'll only add that the pullback up since Tuesday has been capped by the previously mentioned support that is now resistance, that starts at the 2014 high and extends up to at least the 50% Fibonacci line at 881. This situation cannot go on, not much longer. So it'll be interesting to see if target X in the 759 zone below will be temptation enough for a move lower. Minneapolis wheat. In early September, there was the start of a new bullish pattern. It seems to have been prompted by the approach at a steep angle from above of the short medium moving average, currently 959, and rather than this moving average acting as a cap on the market or any rise, it instead acted as a trigger for a move higher. This move higher here seems to have been slower than in the other grain markets, which is a nice segue into the bull channel come ascending expanding wedge pattern formed until early October, and the one I've highlighted in blue on my daily chart, dark blue on my daily chart. I previously called this construction rudimentary, not only because it was back then rudimentary, but also because this market is, as I've said often before, was way behind both Chicago and Kansas City wheat in its construction. You only need to look back at the continuing flatlining long moving average, currently 1035, and the now flatlining medium moving average, currently 940, to see this. Incidentally, this medium moving average seems to have triggered the limited move lower seen in early October. You need to just look at the relative positions of these moving averages compared to the same moving averages in other grain markets to appreciate, how shall I put it, how inferior the actions have been here compared to the other markets. Anyway, as I said, in early October the market broke down through the lower trend line of the bull channel, come ascending, expanding wedge pattern. This left us with the same two avenues here that I saw in both Chicago and Kansas City. The market chose the first avenue, the straightforward move down with potential targets for the break below the bull channel, come ascending, expanding wedge pattern. Thus we have a primary target X on the downside, quite a way lower compared to the other grain markets in the 883 zone, whilst the secondary harder to reach target X1 is down in the 840 zone. Late last week, on Friday, the market made a strong attempt lower, with bearish open and close Black Mariposa that carried on into Monday and Tuesday this week. It looked like the market was going for target X at 883, but on Wednesday the market swerved with a bullish harami, if only just. This now places a question mark on this decline and whether there is enough ammunition to take down prices to 883. Additionally, and it is way early on this point, but it seems best to discuss it now, but there is the possibility for the whole of the July to date action, possibly even the action from June to date, to be a very large double bottom type pattern. It will very much depend, I suspect, on whether the market will drop down to target X and what it will do there, or if it tries up to the medium moving average and what it will do there. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.